Hi guys, KP this side. Hope all of you are doing good. Welcome to vlog number 47 of Decoding Equity Markets with KP series. Uh, this video of mine, of all the 46 videos which I have done till date, this video has taken me the most amount of time for preparation itself. I've put in around 5 to 6 hours of my time just to prepare the content of this video, and I have seriously never taken so much of time, be it for my some presentations or for my CA final classes. No matter, even if I'm teaching 1000 students, I've never prepared so much. So obviously the amount of knowledge which I want to share in this video is loads of it. Humongous amount of information will be shared with you, but obviously one disclaimer that video might be long. Now obviously if I have put in 5-6 hours of time, no matter how summarized my presentation will be, keeping aside my own 12 years of experience, even if I try to keep it very crisp, it will still, I think, go close to 45 to 50 minutes. But I assure you this will be worth your time. So do watch the video completely. Not for increasing my algorithm and all. I'm not a YouTuber, but this video will give you a lot of knowledge for sure. Okay, but if you like the video, guys, if you see it completely and if you like it, at least leave a comment in the comment section of YouTube, just for me to be encouraged to keep pushing in the same amount of hard work. Because as far as the content is concerned, there is so much content that even if I make 470 vlogs, forget about 47th vlog, even if I make 470 vlogs, there is so much knowledge in equity markets that there is no end to it. Okay, there are so many dimensions, there are so many angles of looking at this market, and there's so many things to cover. But you know what, if the response rate is not that great, then sometimes you get carried away and you say, again I have to put in 5-6 hours, and for what? There are hardly any people watching the video. So if you like the video, please share it with people so that more and more people should at least be aware that we are putting in some quality content on YouTube, right? Okay, I don't want to get into all that. So 5 points of discussion, guys. First is, where are we placed as far as the macroeconomic scenario is concerned compared to last week? Now, what are the changes that have happened, and I want to share that with you. You should be updated. Number 2 is, how are the global indices, especially the US and the Indian indices, placed right now? Are we on the verge of a breakout? Are we supposed to now take a back seat, since markets are almost at its 52-week high, especially the Indian indices? We'll talk about that. Number 3 point, the third point of discussion will be, are Indian markets overpriced, correctly priced, reasonably priced, underpriced? That we will try to understand with some data that I have collated. Point number 4 is 2 picks which I feel will do good. One risky trade also I'll give you, which can probably ride the momentum and you can make some quick bucks. So there are 2 plus 1, 3 stocks I'll give you. And last part of our discussion will be the Q&A session, which I'm very happy this time because I have got a lot of quality questions. I've got a lot of technical questions to answer. I'll be happy to answer most of them. I'll try to cover up as much as possible. Starting with first point of discussion, where are we placed as far as the macroeconomics are concerned? First, starting with US, June 14th, Fed has not increased the interest rate, which I told you very clearly in my last video also, that chances are very high that Fed will not go for a rate hike. Understand one thing very clearly, US Fed has not increased the interest rates, but they have, when you cook very delicious food, it's good, the gravy is good, the taste is stupendous, the quality of food is super, but at the end of it you add some extra salt to spoil it all. That's what the Federal Reserve in US is defamed for. They have this tendency because every time some good news is given, but at the end a hawkish view, as they like calling it, a hawkish view is taken, and that is what spoils the party. But now this time things didn't work like that. Thursday, US markets have rejuvenated very well. They have come up again. Wednesday was a little, fall in the market. Friday again, the closing has been a little choppy for US markets. But Thursday, the momentum on the upside was very strong. What was hawkish about this? Number one, they said inflation will be under control. How do they define controlled inflation? Anything around 2.5%. They feel that is only going to be achieved by end of 2024, which means there is still 1.5 years span during which inflation will be moderately on a higher side, and only then inflation will come down to the controlled levels of 2 to 2.5%. Second, they have told that they might go for a couple of rate hikes, not the significant ones, but a small rate hikes might happen anytime between July 2023 to December 2023. Now, that being said, so obviously you first give them a good news that there is no hike in interest rate this time, but then you bring in some negative or adverse news which spoils the party. That, I'll tell you one thing. I don't know if you will accept what I'm saying, but this is a reality of US Federal Reserve. They don't want equity markets to celebrate a lot. They don't want. But why is it so? The simple reason for this is, if equity markets are doing really good, people make money, they make capital gains, or they make F&O income. And this income again is going to increase your consumption power. It gives you more buying power. And more buying power ultimately leads to more demand. More demand will ultimately transform into inflationary environment. So they don't want people to celebrate a lot. They don't want people to do a lot of buying in their equity markets. This is not how things are looked upon as far as RBI is concerned. This is not the situation in India. This is very good actually. I, in my experience, have never seen RBI intentionally coming up with the kind of news which will put equity markets under pressure. I've never seen that. But US Federal Reserve time and again have proven this, that they intentionally want US equity markets to suffer. They intentionally want that to happen. And they have given very clear reason for that they don't want equity markets to be overjoyous, because ultimately that will increase their purchasing power, and in the process they will start putting in more money in the equity markets, make more returns, make more money, and then spend that money to create inflation in the economy. You got my point, what I'm saying? So if you ask me, things are under control. I'm not saying inflation is kind of completely under control, but the interest rate sitting in the range of 5.25% to 5.55% is already high for a country which used to have interest rates in the range of 0.25% to 0.5%. And I don't personally see, even if this 5.25% will ultimately, interest rates are increased by 0.25% a couple of times, 5.25% will hardly become 5.5% or 5.75%, which is not going to have a drastic impact on US economy. It's not like the economy was not going into recession and suddenly, because a couple of more hike in interest rates have happened, now the economy is going into recession. Aisa kuch nahi hoga. I hope you understand my point. So what I'm saying is, even if interest rates are being increased a couple of times from here on in next 6 months, won't impact the markets a lot. Equity markets won't get impacted. This is my verdict as on date. Aage jaake dynamics change hoga, then I don't know. Okay, what is the reason of me making videos every 7 days or 10 days or 15 days? The idea is, in equity markets, you cannot hold a person based on what he said last Saturday or last to last Saturday. It doesn't work like that. For me, something today might appear to be reasonable for buying, and just 1 week down the line, I might tell you, don't buy this share. It doesn't mean that I am not taking my stand. It's not like that. Because every week, so many dynamic factors will play in, so many macro and microeconomic news will play in. My outlook about a particular thing may change over a period of time. So at this point of time, given the situation, I don't feel, even if there are a couple of rate hikes, that is going to have any bigger impact or reasonable impact on the equity markets. Okay. Now, some bad news, some good news as far as China is concerned. Till last week, things were looking okay. But this Friday, when they came up with their May industrial output and retail sales, that has missed the forecast. So post-COVID, the kind of recovery which you expected at least now to happen has not happened. Now, I told you very clearly, one big reason for that is that just the way other countries have come out of, COVID, China is not able to come out of it, because every 4 to 5 months, again, a new variant is coming. Again, there is a spike in the number of cases happening. So economy is not going through that smooth, movement. Every time something good they're trying to do, there is an interruption happening. That is the problem. So Friday, when the industrial data and retail sales data numbers have come, they were very disappointing. So disappointing that most of them have changed their GDP forecast for 2023, the remaining time in 2023. For example, Nomura has cut down its GDP forecast for 2023 from 5.5% to 5.1%. Government is anticipating that GDP will be somewhere around 5%. I'm not saying 5% is bad, but what I'm saying is that based on the data presented for May month on Friday, GDP forecast for current year has been cut down. UBS has cut down its GDP forecast from 5.7% to 5.2%, and Standard Chartered has cut down its GDP forecast from 5.8% to 5.4%. So basically, most of the brokerage houses have cut down their GDP expectations for China. I have been telling this to you time and again. China is one country whose production and consumption, both the wings are very strong. And in order to see an economic recovery at global level, China has to participate, guys. Whether you like China or not doesn't matter, but China has to participate, whether it's their imports, their exports. Their consumptions are also humongous, because of which other countries start enjoying higher exports. But what is the good news? The good news is these kind of weak numbers are putting them under a compulsive situation of giving better stimulus. And that stimulus package, if it is a very strong one, it will help recover the economy at a faster pace, which directly or indirectly is going to benefit countries like India a lot. Okay, so that is as far as China is concerned right now. Now the rest of the two things which I want to discuss are in respect of India. Now, one good thing about India is we have got some $580 billion of forex reserves. The most of our reserves were going towards payment of crude oil. I made plenty of videos on this in the past also. So where are you feeling the pressure? Every month, if you are importing $40-50 billion of crude oil, and crude oil is a necessity, you can't do away with it. So if every month $40 to $50 billion are being spent in crude oil, it means more or less 1 year funding of crude oil can be done from your total forex reserves. That sounds a little dangerous. Now, when Russia has declared a war against Ukraine, sanctions were put on Russia by EU, correct? No, and the thing was very simple: nobody should buy oil from Russia. India has taken a bold step, and they wanted to purchase crude oil from Russia. The advantage which India got as a result of that is that India has been able to procure crude oil from Russia at $68 per barrel, and now in the month of May, June, the overall consumption of crude oil, the overall imports of crude oil from Russia for India has been going up, and the consumption is at its all-time high right now from Russia. The total imports from Russia are higher than the sum total of crude that is imported from Iraq, UAE, US. Now, for obvious reasons, India is importing crude from Russia at $68 per barrel, whereas from Saudi it used to import at $87 per barrel, and from Iraq it used to import at around $78 per barrel, which means your cost has almost fallen by $20 per barrel. And on a daily basis, India is now importing around 1.96 million barrels a day. So this $20 per barrel, when transforms into 1.96 million barrels on a daily basis, it's a huge chunk of money. India is saving on that. If India is saving on that, it's very good for India, because one of how strong your economy is, that is one parameter to judge that is based on your forex reserves. And if most of your forex reserves were being utilized in buying crude, and now that crude prices for you have drastically gone down by $20 per barrel, obviously your forex reserves are going to grow from here. Not just that, India has played it smart. They are now importing crude. European countries are not directly going to take crude from, are not directly going to take the gas or diesel from Russia, because the sanctions have been put on Russia. Now, what India is doing is they're first importing crude from Russia, Whatever consumption is there in India, that is being done. But now they are exporting the finished product after refining this crude, the diesel, they are supplying it to European countries. Obviously, some politicians from EU have, challenged this, and they have not taken it in the right spirit, because ultimately this is defeating the purpose. The purpose was that we should put sanctions against Russia. But if India brings the crude into its country, and then this crude is refined to convert into diesel, and then this diesel is ultimately being passed on to European countries, obviously European countries are getting benefited because their needs of diesel or oil are being met by India. But ultimately, the point is, Russia, instead of selling it directly to European countries, is now routing it through India. And India is getting benefited because, again, they will have their own markup because of this refining process. So this is the situation right now. And the second thing where I see India is doing strong as an economy is the fact that their semiconductor and EV focus is great at this point of time, and you already know about it. Most of you would be aware if you're following the news in respect of this. Now, India has done a pitch, they have addressed to Foxconn in Taiwan, that they should set up their EV unit in India. So Foxconn is basically a company which does manufacturing on contractual basis, and India is insisting that Foxconn should set up its plant for assembling of EV vehicles in India. And Taiwan has committed that in next 5 years or so, they are going to increase their investments in India 8 times compared to their present investments. So obviously, setting up of EV plants in India is going to be going to bring in a big boom for Indian markets. Second, US company called Micron is going to invest $3 billion for chip manufacturing in India. A lot of talks were going on, but now yesterday I read it in the newspaper that they are finally coming to India, and they have also promised that their investments in India over next 5 years will grow multifold. Plus, Apple is expected to manufacture 20% of its total phones in India by next 2 years. These data give you a classical scenario of how strong India is growing as an economy. It's not about BJP and Congress. You have to keep aside the politics, but somewhere down the line, if you see, things are looking very, very, very positive for India. That's what I can foresee. Okay, I'm not pushing you into thinking that India is growing as an economy. I'm giving you my facts and figures to prove the same. Okay, so this gives, so if I do a top-down approach, and first I want to understand how economy is doing, that's why I always start my analysis with economic scenario. And if I first see the economy, then the indices, the industry, and then you talk about the stocks. So if I go by that analysis, I feel India is looking economically very, very stable. Not just stable, they're looking very strong also. The second thing is, how are the indices placed now? That's our point number 2 of discussion. So as far as the indices are concerned, US 3 important indices: S&P 500, Nasdaq, Dow Jones. S&P 500 is right now trading at 4409. Now there is a theory which says that if from your 52-week low you have recovered more than 20%, then market goes into the bull run. Okay, you understood what I said? From your 52 weeks low, if market has recovered or stocks have recovered more than 20%, then it goes into a bull run. Now let's see for S&P 500. Now, because I'm speaking numbers, guys, focus on the message which I'm trying to give you rather than trying to learn the numbers. Don't learn the numbers, just try to understand the message which I'm trying to give you. S&P 500 52-week low is 3491. If you add 20% to it, it comes to 4189. 4189. But today it is at 4409. Which means right now, S&P 500 has already gone past its 20%. And now it is trading above 20% recovery from 52-week low. What about Nasdaq? Nasdaq 52-week low is 10,088, 10088. If I add 20% to it, it comes to 12,105. But right now, Nasdaq is in the range of 13,600, 13,700. It has very well surpassed it, and it's trading much higher than that. That's why you remember I always used to tell you 12,200 is the range, and above that if it goes, it will fly, and it's flying till now. My Videos are there, guys, to prove everything. I don't blow my own trumpet. Everything is given either in post or on videos. Dow Jones 28,660 is the low. If I add 20%, it comes to 34,392. And that's what I told you. If it sustains above 34,200, 34,300 range, it may go up to 35,300, 35,500, 36,000. It is right now sticking in that range, right now close to 34,300, which means it is also on the verge of breaking that 20% value. Almost on the verge. And if that happens convincingly, then you will see 35,300, 35,500 as my next target for Dow Jones. Indian equity, Nifty, low is 15,183. 20% if you add, it comes to 18,220. Right now trading at 18,826, which means it has also comfortably surpassed that zone of 20% on 52-week low. That's why for me the reasonable support for Nifty is at 18,500. And if you remember in my last video also, I told you 18,300, if it goes close to 18,300 is where your sentiments will start changing again. But till that time we are in a bullish mode, correct? Now Bank of America has given some past analysis, and they say 92% of the times whenever this happens, that you go past 20% over and above your 52 weeks low, 92% of the times in next 12 months S&P has continuously gone up. 92% of the times. If more than 20% hike has happened from 52 weeks low, Bank of America has said that 92% of the times in the past, the stocks have continued to go up for next 12 months, which means next 1 year is going to be bonanza. I am not saying that history will repeat. We should never assume history will repeat as far as equity markets are concerned. That's why I don't like technical analysis, because technical analysis speaks the history. Equity markets are so dynamic that any assumption of past repeating itself is being in a fool's paradise. It never happens. Equity markets, it never happens. But this is giving you a good signal. If you, like, you're looking left, right, you don't know whether I should go ahead or not, then these signals are giving you an idea that you should go ahead with equity investments. Understood? Inflation or increase in interest rates, whatever had to happen, a lot of drama happened in last 1 year. A lot of drama. From here on, things are only going to improve. What I mean by that? Last 1 year or 1.5 years, US has increased interest rates by 5%. Will they make it again 5% in next 1.5 years? No. They're only talking about 0.25%, 0.5% increase. So obviously, if no further big increase in interest rates are going to happen, if no such, no such inflationary environment is going to happen where the inflation goes again out of control, then things are only going to improve. Then companies are only going to post better numbers. Then you will have better profits. You will have better EPS. And better EPS will ultimately be captured by a better price in shares. So if you look at the holistic picture of whatever I discussed so far, we're looking in a very comfortable zone right now. Does that mean you should start blindly buying into equity? No, I'm not saying that. Obviously, you will always have to be reasonable, be very rational with what you're buying. But the hints which I'm getting at this point of time are looking all in our favor. Okay, and I'm giving you my proofs, my proof with that. Okay. Also, I was reading the report, the commentary given by Nitin Kamath from Zerodha yesterday, and he's saying, because they are the largest broker as on date, so they can give you very good numbers with whose participation is how much in the market. And he's saying that still retail participation is not high. And still, yes, on Friday, Nifty has done 18,850 and its 52-week high is 18,887. And still, if the biggest brokerage house in India says that retail participation is still not high, then what is going to happen when retail participation is going to increase or the SIP is going to increase? Think about it. I leave it upon you to think. My third point of discussion is how expensive the markets are. So some people I see, they keep saying Indian PE multiples are at all-time high. Indian PE multiples are looking overpriced. We should take a step back, wait for markets to correct. Let's see. If I've tried presenting some data, let's see if that makes some sense. If you see, I'm comparing three countries, India, US and China. This is how I presented my information, guys. If you want, you can take a screenshot. I don't know how good this is, but this is, I prepared it in a way that only I can understand. But this is how I prepared my presentation. Now, people are, if I compare with P ratio, but like I say, there is no one parameter which decides markets are expensive or cheap. I wish equity markets were so easy. Then you need not have people like me around, right? You don't need people to guide you if equity markets are so easy. So if you only look at P multiple and say Indian equities are expensive, so I should not invest. Does that make any sense? Does that sound convincing enough for you to quit equity markets? Answer is no. Okay, let's try to understand. PE ratio of Indian Nifty is at 22 times, which means for every 1 rupee of earning, you are paying 22 rupees. As simple as that. Nasdaq, 19 times, almost same. That's not a problem. That's not what makes you think Indian equity markets are expensive. But PE ratio of Dow Jones is only 12 times. Now that gives you a feeling that Indian equity has become very expensive. China PE ratio, the Shanghai index, that is around 10 times. That gives you a feeling that Indian markets are damn expensive. अगर पैसा लगाना है तो चाइना में लगाएंगे, इंडिया में किस लिए लगाएंगे? Correct, no? But you have to see many other things. So now, if I look at the market capitalization in trillions, Indian market capitalization right now is $3.31 trillion. Market capitalization, you know, of all the shares available in the market, number of shares into market price, that is market capitalization. Indian market capitalization is 3.31 trillions. US is 45 trillions, close to 45 trillions. China is close to 10 trillions. Which means if you look at the market capitalization of all the stocks in the market, India is trading very cheap compared to US and China. But can I directly compare market capitalization? No. I will give you a better way of comparing. GDP India is 3.75 trillions. US GDP is around 27 trillions. China GDP is around 19.3 trillions. Now I'm trying to figure out a ratio. I'm not directly comparing market capitalization. Okay, market capitalization should be a function of GDP of the country. If I go by that, then I will find out market capitalization by GDP. Your market capitalization as a function of your GDP ratio. India is only 0.88 times. US is 1.65 times. And China is 0.53 times. Which means compared to US, Indian equities are almost trading at half the price. Now this is completely opposite what P ratio was telling you. So when you're doing comparison, don't just go by P ratio. That will never give you a complete picture. Some things are expensive because people are willing to pay a price for that. ऐसे तो आप कभी रोलेक्स का घड़ी खरीदोगे नहीं. You will never buy a Mercedes. Because the moment you see something is expensive, you will say, no, this is not worth it because it's expensive. Or you have another way of looking at it, is that something is expensive because people are demanding it. And why are people demanding it? Because there is a brand value associated with it. So if I am buying Rolex for 20 lakhs, as compared to, you know, any other watch like, let's say, Titan for 2,000, 3,000, 5,000, 10,000, maybe I'm buying it because there is a demand for buying Rolex at 20 lakhs also. So just because something is expensive, so it becomes less attractive, that theory does not hold good in equity markets. So P ratio is a very, very, you know, tricky kind of a measure. It will not always hold good, that anything having a higher P ratio is expensive. Does not work like that. So when you see market capitalization to GDP, how much of your market capitalization is justified by your GDP? India is at 0.88, US is at 1.65, China is at 0.53. Yes, China is relatively sasta compared to India, but US is looking very expensive compared to India. You got my point? Okay. So then you should put money in Indian equity markets. Yes, sir, we should. We should put. Next, I am taking debt. Indian debt right now in trillions of dollars is only 0.613 trillions, 0.613, which means 62 billions dollars. US is 32 trillions. That I already discussed with you, debt ceiling thing. And China is 52 trillions. 52 trillions of debt China has. Now, if I do debt to GDP ratio, how much of your debt is justified going by the GDP of your country? India comes to 0.16. 0.16, guys. Your debt as compared to your GDP, India is only having 0.16, which is Like literally your external debt is not at all attention for you. Super for India, superb. US is 1.19 times. Very risky. Already discussed, sir. I'm not going into details of this. China is 2.68 times. 2.68. Just see how pathetic is their situation compared to India. Ideally, it should be, a lot of economists have said, ideally it should be 0.6. India is much below that level also, which means you can still borrow external debt. Tomorrow, if I have to increase the production in my country, tomorrow, if I have to grow my businesses, tomorrow, if I have to go for more productions, more manufacturing activities, and I need money for that, I can easily borrow. My GDP justifies that. Now you say, is India equity markets expensive? Is Indian equity markets expensive? You think about it. These are the kind of factors you have to see. पर इतना मेहनत करेगा कौन? इसमें तो टाइम लगता है ना सर. सीधा पी रेशियो उठा के देख लीजिए एंड मार्केट्स आर एक्सपेंसिव इफ योर पी रेशियो इज हाई. इतना मेहनत सर कैसे करेंगे? Without hard work, you don't get anything. The only thing you get without hard work is dandruff. Okay, we are done with most of it. I'll discuss my picks now and then finally I'll answer your questions. We'll try to wrap it up in the next 20 minutes, guys. We are already 30 minutes into this video. My first pick is Gloucester, not MG Gloucester. MG Gloucester I don't like, it's a bulky car. But Gloucester is one company which is involved in textiles business, primarily into jute related products manufacturing for house furnishing, floor mats, floor covers, those kind of things. Anything and everything relating to jute they manufacture. They are also into exports. Currently trading around 692 with a 52-week high of 1012. It happened ex bonus. It went up to 2000 also, and 52-week low being 425. At current market price of 692, Gloucester is trading at a discount of 30% compared to its 52-week high. Although mid cap and small cap have shown a lot of upside in the last 2 to 3 months, but this is one stock which is not catching eyes of traders or investors at this point of time. Face value 10, EPS of 50 makes it reasonable and decent stock. Book value is 986. The stock is trading at a price to book value of less than 1. And the moment that happens, KP is very happy. It's only listed on BSE. So tomorrow, if based on my recommendation, you try to buy Gloucester, it will be only available on BSE. The volume of shares for this company is almost negligible. There are days when only 1500, 1600 shares are traded. Only 1600. Promoter has no interest in you trading in this share. That's why promoter is holding 72%. DII is holding 14.7% and rest is with the public. There is no FII holding as far as I have seen the data. Dividends, decently they pay. Next dividend is on 28th July. So if you buy the share now, you will be entitled to a dividend also, 20 rupees. 7th November 2022, a bonus issue was done in the ratio of 1:1. Good, decent. Its share capital is only 10 crores. 10 crores. That's why there are no shares available for trading. But if you get an opportunity, buy. But when you buy shares, be very careful. Try to put limit orders and slowly increase your order value. Because if you put a market order, no, they will give you at any price because there are hardly any sellers. Never put market orders when you buy shares, guys. You will someday be in deep trouble if you do that. Put limit orders, धीरे धीरे दाम बढ़ाना. You have to play that game. I like playing that game. 692.25, then 692.35. I have got a lot of time. There's nothing I have to do. So 692.40, 692.50. Don't go with so small spreads, but you can keep increasing the price looking at the seller data available. Nowadays data is available, so you can play for some time with that. Good stock. 692 buying price. 770 is my first target. 770. If you don't want to sell at 770, you can still hold on to it for 850. First target 770, second target 850. Done. Okay. My next pick is Teamlease, the company involved in staffing workforce. Just like you have Naukri, same ways Teamlease will provide human resources for jobs. Currently trading at 2387, a 52-week high of 4000, all-time high of 5550, which happened on 11th of October 2021. If I compare with its all-time high, the share is trading at almost a discount of 55 to 57%, which is very high. But even if I compare with 52 weeks high price, the share is still trading at 40% discount. Face value is 10, EPS is 65. Revenue in last 5 years have grown from 4,440 crores to 7,870 crores. But that's not the problem. The problem is the net profits have not shown great numbers as far as last 5 years is concerned. And net profit has gone up from 98 crores to 111 crore. That is 111 crores. But from 2022 to 2023, there has been a significant jump in profits, which is from 39 crores, the profits have gone up to 111 crores. But this is where I feel a share is a very good buy, because the increase in profits in last 1 year has not reflected well in the share price. This is what makes me give a comfortable buy on this stock. EPS is 65 with a face value of 10. This stock looks very good to me. Promoter is holding 31.5%. FII is holding 37%. DII is holding 25%, guys. Just see how much the FII, DII and promoters are holding, with only 7% left for public to trade. Only 7%. Eyes closed, go for this stock at 2387 with a first target of 2500, second target of 2625 to 2650. You can easily hold it for 2650, but I'm still giving for somebody who wants to play the volatility, first target 2500, which is hardly some 5% upside. But if you want continue holding it, you can go for a second target of 2625, 2650. Bonus pick, not recommended for people with faint heart, not recommended for people who don't like playing the volatility. They don't enjoy much. HEG, HEG, one of my favorite stocks, available at 1586 with a book value of more than 1,000 rupees, a massive EPS. China stimulus, China opening up will create good momentum in this stock. So I'm playing the news, a contingent news. So it's not for people who are very risk averse. You take this bet only if you are willing to take some risk, not much risk, some risk. ले सकते हैं तो ले लीजिए. HEG at 1586, easy upside up till 1750. 1586, target of 1750. If you can hold it for long time, 2000 plus. 2000 plus. Okay, chalo, we're done with this, guys. I think I have done a decent job of finishing things within reasonable time. Q&A, do stick to this, guys. If you want to learn certain things, do stick to this today, because I have got some 15 questions to answer, but people have been good with their questions. First question from Karthik: what is the job data impact on interest rates? I told this in the earlier videos, Karthik. If too many jobs are created during this inflationary environment, when there is interest rate hikes being done and inflation pressure is there, too many jobs being created is bad for Federal Reserve. So if jobs are created at a pace faster than the forecasted rate, it's not a good sentiment for the Federal Reserve. With too many jobs being created, it means there is demand for employees. It means they can negotiate better for their packages. Better packages for them means better purchasing power. Better purchasing power means better demand in the economy. Better demand means in inflationary environment. So generally, jobs going up is bad for Federal Reserve. Why is US and UK important in Indian context and not Japan? Japan is operating as a different isolated nation altogether. You know this, Japan equity markets are hitting all-time high on a daily basis right now, because Japan is, you can't compare interest rates of Japan with any other country, for one simple reason, that Japan is a country which operates on a negative interest rate. Do you know that? Normally when you keep your money with banks, you get paid interest. Japan is one economy where transacting your money is very difficult. Keep lending your money is very difficult, because over there are situations when banks will charge you interest for keeping your money with them. So Japan is one nation, you can't go mimic the interest rate policies over there, because they have a very weird policy. And right now, one reason why Japan equity markets are doing so well is because they are continuously bringing in stimulus to revive their economy. There was a time when Japan used to be a country with best GDP. Now they are lagging behind for some of the other reasons. But overall, yes, US is one country which sets the mood for the global situations, whether you like it or not, but that is the fact. as a true Indian, I feel someday it will happen that Indian equity markets will have a lot of impact on how things are going to be globally. Yes, you may say that I have that bias for India, but if you open your eyes and look at things how they're transpiring around you, we are heading for something really good in India. That's what I feel, guys. Okay, Irshad, how to decide the targets? I personally decide my targets, Irshad. This the only technical thing which I use in my analysis is support and resistance. So I generally go by resistance, but sometimes I also incorporate relative analysis into it. Like what I'm trying to say is, Jubilant Food Work, going by the charts, the resistance is at 525. But if I look at the relative picture, HUL, Nestle, Marico, Dabur, they have all been trading almost at its 52 weeks high. Example I'm giving, okay? But Jubilant has shown significant correction. In that case, if its resistance is at 525 and the stock is right now trading at 485, I will not tell my clients to buy the share and hold only till 525, because relatively when I see other FMCG stocks, they are trading at their 52-week high. So I feel there is more potential for Jubilant to go up. So I will not look for first level of resistance. I will rather go for R2, R3. I'll go for next level of resistance in this stock. And I'll accordingly set my target. A target at a place where I feel, yes, now the stock is looking reasonably priced when compared to other companies in the same sector. You get my point, what I'm saying? So you can't only go by resistance and supports for the stocks. You also have to see relative analysis. That's what I do at least. Sharon is asking me specific sector to benefit from Make in India. I think I already answered that. The semiconductors and chips is where I feel most growth is going to happen, because that is where India is focusing right now. Second, he's asking, do you see significant corrections in the market? I think that also I answered in this video itself. Just I told you how bullish I am on Indian equity markets. And third, he's asking, Germany and New Zealand recession, do you think it will have any impact on markets? Done and dusted, guys. Done and dusted. We already know there are countries suffering from recession. It won't impact India as long as India is fundamentally placed in a better position. And that is exactly what is happening right now. As far as the RBI governor last meet was concerned in the monetary policy, they have told it very clearly that we are much better placed when compared to the kind of hardships which other countries are facing as far as their situation is concerned. Yes, indirectly you get impacted by this, because other countries having recession will impact your exports, correct? So that kind of impact will be there. A slowdown will be there, but direct impact is not going to be there. It's not like if Germany or New Zealand or any other country for that matter has a recession, it will indirectly bring a recession in India also. Doesn't work like that. Prashant is asking me, what fundamentals do you look for in a share when you buy them? And he also said that in vlog 8 you have already shared some of them, so he does not want me to give the simple ones, the ones which I shared earlier. The other ones he's asking. The other ones would be, guys, I would personally see what kind of holding FII and DII are having in a country and in a company, and if they are continuously going up, I am personally taking it as a matter of confidence. If FII, DII are continuously increasing their stake. Also, I personally like companies where public holding is less. I told this in my last video also. I will also see if promoter has pledged his holding. If he has pledged his holding, it's a negative for me. It's a red flag for me. Why did the promoter pledge his holding? If he borrowed money, what purpose? Is that purpose sounding reasonable? All these things I will see. I will also see the debt restructuring in the company. When they had good profits, did they repay some of their debt? Are they able to pay debt from their own reserves and surplus? Is it every time they're going for refinancing of their debt? That is, to pay A, they will borrow from B. To pay B, they will borrow from C. These things also I will see. Too much of debt is bad. So these are things I will see other than PE ratio, price to book value, net profit margins, return on equity, return on capital employed, EPS. These are the things which I told in my vlog 8, I remember. These are the things I will see apart from that. Then he's also asking me, what is the best strategy for FNO? I personally prefer going long on stocks with a put option, or going short on stocks with a call option hedge. That's what I personally like doing. Or I will, like I told in my last video, I will create some kind of option spreads. Buy a call at a given strike price, sell a call at a higher strike price. That kind of a strategy I will use. Deepang and Hasmukh both are asking me, why suddenly IEX is under so much pressure just based on one news, that is market coupling news that has come, and how to deal with such situations where stocks sometimes just based on one news they lose their ground and they start falling like a pack of cards. That was the question being asked to me. See, I feel, Deepak, the thing is, how markets will react to a given news is not in our control. But what is in your control is, did you do your analysis properly before buying a share? Do you still have belief in the fundamentals of the company? Have you come across a news which has made you structurally change your fundamental analysis about a company? If the answer to all this is no, continue holding good stocks. If you feel the stock is still good, continue holding it. The day this news came of market coupling, what happened? They simply said government will now decide on the energy prices. The independent powers which were given to IEX for deciding the price of energy probably will be taken away from that, and government will decide what should be the transparent price. This is what I understand. Although there is no clarity on this matter, but the very next day IEX CEO and MD has come and he told very clearly that even if market coupling happens, it is not going to have much impact on our profitability, and people have perceived market coupling in a wrong way. The moment this kind of a news comes, when the CEO MD comes and speaks to the stakeholders, at least he is getting bothered to come and speak to the stakeholders. In such situations, obviously you should continue holding the stock. Now let's say you bought IEX at 200 and now it's trading at 125. It's a good time to average, which means if you are having 100 shares of IEX, picture is still hazy. Don't buy 100 more, at least add 50 stocks, at least buy 50 more to average out, and then see how it's placed from there. Now like if you see last 5 to 7 days, the IEX share has been consolidating in that 124 125 zone. So good time to average now. Don't completely average out 100%, at least 35 to 40% of your holding you average out, and balance again. If it further falls, then we will average. Okay, so if you personally feel the stock is good, learn to hold on to it. Market reaction is not in my control, but yes, market reaction should bother you in a way that you want to recheck if the fundamentals of the stock have changed. If that is the case, then yes, you might have to take a tough decision of exiting the stocks, or you might continue holding the same stock with the hope that someday it will revive again if fundamentals are good. Okay. Neeraj is asking me, how is HLE Glass Coat? I think it's a good company. You can have it in your portfolio. But if you're planning to do fresh buying, Neeraj, I would personally not be much in favor of doing that. I didn't find anything that attractive in the stock. Okay. Shravan is asking me about the hawkish view of the US Federal Reserve. Already answered Shravan on this part. Then he's asking me, how about the IT stocks in India? Why they are not performing as good as the Nasdaq is doing it? That creates an opportunity for you. That is why I keep shouting, go for IT, go for IT, go for IT. Why do I say that? Because Indian IT sector has been penalized brutally beyond a point. And I feel this is a great opportunity, especially for large caps like, Infosys and TCS. I feel there is a huge opportunity now. Infosys around 1280, 1290. There cannot be a better buying price for Infosys with a target of 1450, 1500. TCS at around 3150 is a great buying opportunity with a target of 34, 3500. That's what I feel. He's also asking me anything from pharma. I personally like Divis Lab, although Divis Lab numbers have not been great in last 2 to 3 quarters. That's not important. The guidance has also not been great. But if you want to do a SIP kind of investment in pharma, I think Divis Lab is good stock. I'll give you another gem of a stock. Everybody, guys, listen to it. Gem of a stock, Gland Pharma at around 1009 is a beautiful stock to have in your portfolio. It has been butchered down like anything in last couple of months. Great stock at around 1009. Gland Pharma, GLAND, Gland Pharma at around 1009 with a target of 1185, 1190. You can buy it. Okay. So at least a 20% upside is what I see in Gland Pharma. Rajesh is asking me about Ineos Styro. I think the new name for this company is Strinix. It's a good stock, Rajesh. Almost trading at its 52-week high. It's a high dividend paying stock. The company is good. But This year the profits for this company has been less. I would suggest if you want to keep it, because it's a high dividend paying stock, for last 3 years the company has paid very good dividends, then keep it. But if you are keeping it for capital gains perspective, don't keep it, because the numbers have been bad for 23. Number two, the 62% of the shares with the promoters, the 100% of it is pledged. That's a red flag for me. I personally don't like it. Prashva is asking me, how are you able to know so well about the momentum in the stocks, like in case of Deepak Nitrite, in case of Rajesh Exports, and even in case of Coforge. Prashva, first of all, thank you that you realized this and you recognize this. Thanks for acknowledging. But I'll say something. When you do something for 12 years, 365 days a year, 24/7 every day, I think some power to analyze markets will come in you. I don't know how to answer this, but honestly speaking, I have not done any specific study which teaches you how to play the momentum. I don't know, seriously. If I knew, I would have incorporated that in my Equipedia course, but there is no such thing. I think this is more of understanding price action by constantly looking at the market for 12 straight years. That has taught me this. Okay, this is a support and resistance kind of plays in my mind now. Okay, Nilesh is asking me, what is the difference between return on capital employed and return on equity? Very good. Return on capital employed is calculated based on both equity and debt. That is, you consider EBIT as a profit measure. That is without deducting interest. EBIT, earning before interest and tax. ROE is calculated only for equity shareholders. That is after removing interest. So if your return on capital employed is very high, but your return on equity is low, that clearly suggests you have got very high interest burden. Understood? So if some company ROCE is very high, ROE is low, I would stay away from those companies, because it means their profits are not good enough to look after their interest cost, the interest burden, which means the debt exposure for the company is high. For some companies, ROCE, ROE is same. That means company does not have external debt. Long-term debt liabilities are not there. Or if the difference is less, that means company is having very limited debt, so their interest exposure is less. Okay. He's also asking me price to book value. I think price to book value, Nilesh, I have told many a times, it is the price divided by net worth of the company. Net worth is the share capital and reserves. So this part I have discussed many a times. You can see my old videos. Vivek is asking, Nasdaq all-time high, but why Indian IT is not performing? Is there any artificial intelligence impact? I have answered this many a times, Vivek. Nasdaq at all-time high is creating a classical opportunities in Indian IT. For no reasons, I feel Indian IT is under pressure. But it won't be fair to say that Indian IT has not revived from its low. A lot of stocks have revived, right? I've given persistent at around 30 to 3300, if 3500 maybe, and now it is 5000. Coforge I started giving from the levels of 36, 3700. It is almost at 40, 45, 4600. LTIM I started giving from 38, 3900 levels. It's now 5000. LTTS I told at around 31, 3200. It's now around 3900. So it's not that recovery has not happened. Yes, on the index front, it's not looking that recovery is as good as Nasdaq. For that one big reason is the top-notch stocks like Tech Mahindra, Infosys, TCS have not performed till now, and that is where the opportunities are created. Again, if you're asking me about the artificial intelligence, I feel artificial intelligence is only going to increase the productivity of these companies and their employees. Artificial intelligence is not going to take away any business from IT. Artificial intelligence is only going to increase business for these companies. Okay, I hope I answered you. Pratyush is asking me, ACC, it's a superb stock, guy. Pratyush, go for it. 1850, target 2150. The way cement sector has performed, the cement stocks have performed, especially Ultratech Cement, JK Cement, Dalmia Bharat, Birla Corp, all these stocks have done. Ramco Cement, all cement sector stocks have skyrocketed. They fired, but because of Adani and Hindenburg problems, ACC has still not been able to catch on the upside. But ACC is a super buy at 1850 with a target of 2150, 2200 in mind. PNB, already 100% upside has happened. I personally don't like it. I told you last video also, if I have to buy something from banking sector, my top picks will be a large cap, that is HDFC Bank and Kotak Bank. Okay. Nagaraj, sorry, is asking me about Adani Wilmar. I personally feel Adani Wilmar is a good stock, but if you saw those 800 levels and you didn't sell, and now you see those 400 levels, I know it's painful. Then I would suggest hold on to it. But if you're thinking to do fresh buying in Adani Wilmar, go for Adani Transmission. That is a better stock. I've told this in my earlier video. Trading around 820 range, hold it for 1100, 1200. That's 50% is the upside which I see in that stock. Varun is asking me some list of shares he gave me. Asahi India is the only stock in that list which I feel is worth buying. And last question is from Anil Kumar, who is asking me a very good question: why India is buying so much of gold in the recent past? The reason for that is very simple. You buy gold out of your forex reserves. Forex reserves, India has around $580 billion of forex reserve. Your reserves are always in dollar terms. But if your reserves are expressed in dollar, and you see dollar is continuously under pressure as a currency now because of inflationary environment in US, so the one way to diversify your exposure in forex is by buying gold. And if a currency is under pressure, or if there are geopolitical tensions, or if there is inflationary environment, gold has turned out to be the best asset during such times. That is why not just India, China, Singapore, and many other countries have also started. Thailand, they have started buying a lot of gold. The central banks have purchased a lot of gold in last 1 year or so. One big reason for that is diversification. You don't want to hold on to forex, that is dollar, to such an extent. Plus, gold pricing is very fair. Selling of gold is very easy. Liquidity in gold market is very high. And as far as gold is concerned, against gold you can also from the international monetary markets, borrowing money against gold is very easy. That is why they buy gold. And recently, because of this hyperinflationary environment, you don't want to keep your money in bonds. Otherwise, they also look at bond investment as an alternative. But when interest rates are going up, bonds which are paying you fixed rate of interest does not look attractive. So that is also one way of taking out your money from bonds and putting more of it in gold, because gold does more justice to inflationary environment. And when situations are uncertain, you will always see more funds are being channelized into gold investments. Okay, chalo, I hope the video has been useful. We tried doing it in 15 minutes, but anyways, we are able to do it in less than 1 hour. I hope you enjoyed the video. If you do enjoy the video, guys, I request you to leave a comment in the comment section. At least I get to know that there are people watching my video. Okay, chalo, bye bye. God bless all of you. Stay bullish, stay invested in equity. Thank you.